Tax write-offs for entrepreneurs and business owners. What up guys? A lot of you asked me to make this video, so here I am about to make this video for you. Now, I am not a CPA, I'm not an accountant, I'm not a tax advisor, and unfortunately, most of them don't know what the heck they're talking about. They get paid $70K a year. I make that in 1 month. They know in theory what I actually have to practice in reality. So let's stop learning from the fake people and the people that don't know what they're talking about, and start learning from the people that have actually gone through it and understand money and how it works, all that stuff, okay? So let me just break down a few things for you guys. Whether you are in Europe, whether you are in the United States, whether you're in Canada, whether you're in Papua New Guinea, whether you're in Costa Rica, it doesn't matter, okay? This applies to everybody. Now, your government might work different than mine and what we've got going on here, but most countries have what we call sole proprietorship, okay? And a sole proprietorship just basically means that it's just you own the business, all liabilities are on you, you're responsible for everything. So there's that, okay? There's that in Canada, there's that in Australia, there's that in the United States, there's that all over the place, Barbados, okay? So that exists. In the country that I'm from, the United States, and in most countries, you have what we call LLCs, better route to go. I want to break down a couple things. So we'll go over a little bit of business structure. This is important, guys, because while you're making money and not really caring, look, if you haven't done your taxes yet, if you don't know about accounting, if mommy and daddy are doing something for you, if you're going to H&R Block or some bullshit like that, look, you're missing out on a lot of stuff. I paid about $31,000 last year in taxes. No, sorry, I paid $50,000 last year in taxes. I paid $31,000 the year before. I'm gonna try to only do about $60,000 this year. And if I was a sole proprietor, my $60,000 in taxes would be about $220,000, $250,000 in gross income. Now, obviously, I make a lot more than that, and I gross a lot more than that, but because I understand taxes a little bit more than the average Joe, and I'm putting that into practice, I'm able to pay less, still prove more income, and it works out for Uncle Sam, works out for the government, and it works out even better for me. Don't know if they should know that or not. So let's talk about a couple things. Gonna talk about structure, gonna talk about write-offs. Now, when it comes to write-offs, pretty much anything can be written off, okay? If you are buying a suit to go ahead and go to a presentation where you're speaking and it's for business, okay? That suit, the gas that you spent to get there, the flights that you booked, the hotels, okay? All of that is a write-off. Whether or not you choose to write that off is up to you. You might be asking, why would you not write off something, Ben? Well, here's an example, okay? One of the things that I'm doing at the end of this year is I'm gonna be building a storage unit complex and an apartment complex, okay? And now, I know going into this, I'm required to have 25 to 30% down, all right? And the project that I'm doing, the very first one I'm gonna tackle, is gonna be about 2.5 million, all right? So I'm gonna walk in needing to have about, let's just say 600K down, and I'm gonna have a little over 1.9 million that I gotta finance, okay? That 1.9 million right there on a mortgage, whether it's 20, 30, or let's just say it's a 30-year industrial, commercial sort of loan, okay? That 1.9 million is gonna be about $11,000, okay? I'm gonna have about an 11K per month mortgage, all right? When it comes into the banking world and borrowing money, which it's okay to borrow money for an asset, okay? Car's not an asset, your regular house that's not producing you income is not an asset, okay? Your motorcycle, your boat, that's not an asset. You're going into debt over stupid shit, all right? I'm going into debt over things that are gonna make me money, and I don't have to pay tax on that debt, okay? So that's the cool stuff. Mom and dad don't know that, your marketing professor, your finance degree didn't teach you that. So I got 11K a month that I gotta pay out to this. Banks typically loan up to about 40% DTI. DTI stands for debt to income, all right? So if I've got to be able to qualify for a loan that's $11,000, and let's say I got $3,000 in other stuff going on. Maybe I have a car payment. Maybe I'm leasing something. Maybe I got, insurance or whatever. I just have regular bills and stuff like that. Well, on paper, I need to be able to prove about 2.5 times that. So really, I need to be knocking on about $26,000, $27,000 a month net I have to prove. Now you take that, multiply it by 12, I've got to prove that I make somewhere around 320K a year. So here's what I do, guys. Here's where your write-offs come into play. Keep track of everything. Put it in a Google spreadsheet, okay? QuickBooks is a great tool to use as well, okay? If you're just getting started, Google spreadsheet is free. You gotta categorize everything, okay? So you're gonna have food, okay? You're going to have marketing, which is ads, all right? It's anything like that. You're gonna have contract work. Maybe you pay somebody to edit your videos. You're gonna have tools. Maybe, for example, I've got a lav mic I spent $60 on, okay? Maybe I have an $800 camera that I use to make these YouTube videos. Maybe I have like a recording studio set up, okay? We've got the Ozone that we do live 7 p.m. EST every Monday, okay? So there's marketing expenses. You're putting all that in. You put your hotels in, your travel, your plane flights, you categorize all of this. Now, at the end of the year, what it comes down to is those are all write-offs. If you know that you're gonna be investing in something, if you want some credit opened up, okay, if you wanna be able to qualify for a loan to be able to get your business further, make you some money, diversify your income, all right? You need to be able to prove that. So sometimes what you're gonna do is pay a little bit more tax so you can prove your AGI, adjusted gross income, is a little bit higher. So you qualify for that loan or whatever it is that you're doing. Now, I'm not gonna go super in depth in that. We're gonna talk more about write-offs and business structure on a basic level here. But the reason that I'm doing this is because I take my earned income, okay? My earned income, what I'm doing, I'm selling my courses, I'm getting paid to build people's businesses, I've got some in-person mentorship, I've got some programs, some mentorship programs, some courses, all that stuff, okay? This is all my earned income. Even though I generate it passively, the IRS treats it as earned income, all right? So when I'm taxed, I do pay a little bit more tax, but the real estate income, the investment income is oftentimes by the IRS considered passive income. So I like to convert my income. So what I'm doing, guys, is I'm converting my income. I take my earned income, okay? And let's say that my earned income is taxed at, let's just say at the end of everything, my earned income is taxed at 28% cumulatively, okay? I'm taking my earned income right here. I'm not paying myself any of it. I'm putting it over here, converting it into investment income, which is considered passive, all right? And then my tax is somewhere around this right here, 10 to 20%. I don't pay myself shit out of here. I don't touch it. I bring it over here into my investments, and then I pay myself out of this, pay less tax. I'm converting, okay? Mr. Finance, Mr. Marketing degree, Mr. Edward Jones never taught you that. Won't learn it in your Roth IRAs, won't learn it in your retirement accounts, your pensions. Mom and dad don't know how to do it. Middle class is oblivious to it. School curriculum doesn't teach it, all right? And I didn't learn this in school either. I didn't go to school, all right? Hey, if you love this so far, new, refreshing information, smash that like button. If you have any questions that are triggered in your mind, I'm sure you got a lot of questions right now, drop in the comments below. I'll answer every single one, okay? So that's what I'm doing there. Now let's talk about structure, everything like that. Recap, guys, write-offs, put it in a Google spreadsheet, categorize it. You got your marketing, you got your food, the food that you're having to buy while you're traveling or while you're eating, working at the coffee shop with your computer there, and what you do is work online and you're sending emails and it's a work-related email, okay? If you paid $1 for that napkin right there, all right, well, that's a write-off. You use your cell phone for work, okay? That bill, keep track of that monthly bill. That's a write-off. You're running Facebook, Google, in-stream ads on YouTube, those are write-offs. Put it in the ads, okay? Your contract work, those are write-offs, okay? I make $20,000 a month, $8,000 of it gets paid to somebody else, okay? Well, really, I made 12. That $8K is a write-off. Categorize it. Put it all in categories. Don't jumble it together. CPA is gonna charge you more at the end of the year, okay? Another tip that I have for you before we get into the business structure and really how to make so much more money by saving in the taxes, have yourself a good CPA. Work with a CPA that works with multimillionaires. Don't do the 5-6 figure bullshit. Okay, they don't know. They don't have to actually put this into practice. All right. Here's the next thing. We've got SPs. Okay, we've got LLCs, and in these we have Cs, we have S's, we have Ps. Okay, SP is sole proprietor. This is where you'll pay the most tax. It gets taxed like regular income tax, okay? You'll pay X amount on the first $10,000, and from 11 to 24,000, your tax rate increases. From 24 to 33,000, your tax rate increases, okay? I don't remember all the brackets, but the top level is 37%. Combine that with a corrupt state like California, where you're in the top income level, you'll pay 50% to state and government. It's socialism. You'll give up all of your money. You'll lose half of it. Every $500K you're earning, you keep $250. All right? So that's bullshit. So you don't want to be a sole proprietor. Plus, all responsibility is on you. Usually sole proprietors cost like $25 to register. LLCs could be $30 to $100 to register, all right? Not a big deal. Go the LLC route. Sole proprietors, you have all the liabilities because everything is in you, okay? Everything is on you, okay? Somebody says, hey, I want to sue you. They can come after your car. They can come after your business. They can come after your money. They can come after your diapers. They can come after your G-string. They can come after your penis. It doesn't matter. They can come after everything, all right? So you don't want to be a sole proprietor. All liability is on you and you get taxed the most. LLCs, a little bit better game to play. LLCs, limited liability company. What's really cool about an LLC is oftentimes you can diversify. So I can have my business that sells this product as the LLC, and then I can form a sub-entity within that business that has this asset, my car, okay? Maybe it's not in my name, Ben Oberg. Maybe it's, whatever, my company, okay? Maybe I want to build a house. I can have that as a sub-entity in my LLC. Now if somebody comes after me that didn't like whatever, a particular module in one of my courses, or maybe they didn't like the way I mentored them or something. If they wanted to pay all the money in the world and had a better attorney than me, maybe I'd lose. Maybe they'd sue me, but they can't come after my sub-assets. They could only come after whatever asset is in that part of the business. That's why LLCs stand for limited liability company. Now there's different ones with different flexibilities. There's corporations, C-Corp, so a C-Corp, okay? A C-Corp would be like a Facebook, would be like an Amazon, so Bezos or Zuckerberg, they've got C-Corps. A lot of corporations are incorporated in Delaware, in the state of Delaware, because they have more leniencies when it comes to tax. Microsoft was actually incorporated in Delaware, all right? And then they came back to incorporate in Washington, and Washington also doesn't have any state income tax. Neither does Wyoming. Most people think that Nevada doesn't have state income tax. They do after you gross $4 million a year. Texas doesn't have state income tax. Florida doesn't have state income tax. Alaska doesn't have state income tax. And I think New Hampshire just became part of that list as well. The corporations though, C corporations, are usually taxed domestic. All sales US, at around 20%. And then foreign sales, it's like 13 point something percent. Here's the problem. This is the tax rate the company pays, but any money that you pay yourself out of that is subject to tax as well. So you have double taxation, all right? So really C corporations are usually long-term plays. You usually do a C corporation if you're gonna keep the money in the company, not really pay yourself a whole lot, and your end game is you're gonna sell the company for billions of dollars. I mean, imagine how much Facebook or Amazon, imagine how much Bezos could sell Amazon right now. Maybe $1 trillion. It's probably gonna be the first $1 trillion company. Facebook, Zuckerberg, he got an evaluation on just Instagram for like $100 billion or something like that, okay? So it's kind of an end game play, all right? Where you're gonna hold this asset. This company is an asset, okay? They're not paying themselves tons out of it. Usually C Corps, you're going to sell stock, go public in them, make your money that way, and ultimately sell the company way long down the road and then pay that capital gains tax, which is a much lower rate than sole proprietor income, okay? That's what you're usually doing, all right? Now, of course, they're taking a salary out of it. They're paying themselves to keep the bills, so Bezos can have his 3 houses or whatever he has, right? Own an island in Hawaii or whatever. But reality is he's got to pay personal income tax on whatever that number is that he takes out. So you are subject to double taxation on those earnings. C corporations are generally big companies. They don't have to be, but they're generally companies where they go public. They're selling a lot of stock, a lot of share, all right? And the intent is to sell for a massive profit later on and pay capital gains. S-Corps, okay? All right, I'm an S-Corp. Millionaire Mafia is an S-Corp. S-Corps have a couple of really cool advantages. When I talked about diversification and having sub-entities, S-Corps are designed for that. So if I want to start developing houses, I could put that in here. If I want my car, this is a horrible car, all right? If I want my car here, put my car. If I want my business deals where I'm building people's businesses, I can put that in here. Somebody wants to sue me because maybe they like my car, all right? Maybe they like my car. In the state of Louisiana, they did this study. What's the best way to get rich? They said sue people or lottery tickets, okay? Broke mindset, horrible mentality. So Maybe I parked too close to them. They didn't like that. They want to sue me. They can just come after this. But with these, I'm protected here. Limited liability company. This is a great structure, okay? Now with S-Corps, here's what's really cool. If, all right, I'm structured as a sole proprietorship and my AGI, my adjusted gross income, in other words, what I net, what I prove on paper that I earned, okay? If I write off, say I make $1 million and I write off 900,000, so I got 100K left, okay? 100K. On my SP, on my sole proprietor, I'm gonna pay about 33K in federal income taxes. And we're not even talking about state, okay? I'm gonna pay 33K in federal income taxes, okay? If I'm an S-Corp, here's what's really cool. You might not need all this 100K. You might not need that. You're putting some back into your company. Maybe you only need 3K a month, right? You only need 3K a month to feed yourself, put food on the table. So out of 100K, 74K stays in the company, all right? You pay yourself 36K, or I'm sorry, 64, all right? You're gonna pay personal income tax on this 36K, but at a marginal level. Like maybe your average might be 22%, okay? So maybe you end up paying around 8K, all right, in sales, or excuse me, in income tax, okay? Well, this 64K that you kept in the company, subject to a different tax rate in here, okay? Subject to a lower tax rate, okay? If you keep this money in the company, one, if you roll it into next year and you continue investing it, you're deferring that tax. You don't need to do anything. You don't need to pay any tax on it. You're only gonna pay tax on this, which is right around 8K, all right? Two, if you decide to claim income from here, all right? It's gonna move right into here, all right? But it gives you the option to separate them, all right? You take what you need to pay yourself out of it, keep the rest in the company. This now is a growing asset. Keep it in here, keep it in here. What you do with this, generally you're gonna keep it in here, you're gonna reinvest some of that into your marketing, running your ads, all of that different stuff, whatever you wanna do. But at a certain point, say a year, 2 years, 3 years down the road, you pull it out. I said rolled. 2, 3 years down the road, you pull this out. This is now capital gains, all right? And with capital gains, you've got two different types. You got long-term and you've got short-term capital gains. Short-term, usually taxed at 20%, and sometimes, depending on the type of capital gains, it can be treated as personal income tax at a higher rate. Generally speaking though, 20%. Long-term capital gains can be taxed as little as 10%. S-Corps, for most of the people that I work with, S-Corps are usually the way they go. And the last one that you have is partnerships, P, partnerships. That's just a hard no. I don't care if your partner's mom or dad. I don't care if it's your girlfriend, your boyfriend, your wife, your husband that you've been married to for 47 and a half years, okay? I don't care. Bottom line is, usually one person hustles harder than the other, and usually somebody fucks up something at some point. And if that fuck up of your other half, of your partner, happens and it ain't you, you're gonna get dragged into it, okay? You're a partnership. If they crash the company car and kill somebody, you're responsible. You can go to prison too. It is your car, all right? It said Bob Smith and Bob Evans, and you're Bob Evans. Bob Smith fucked up and drove the car into a pole and hit a lady on a bicycle and killed her, okay? Well, guess what? You're responsible because it's the partnership. Your partner decides, you know what? I don't like the way you work. I want to sue you. Can come after all your stuff, and if he pays the lawyer a little bit more and he's got a little bit better of a lawyer and the Google ratings are higher, you lose. Don't do partnerships. Guys, if you're brand new to the channel, make sure to subscribe. I know this was a lot of information. Smash the like button. If you have any questions, drop them in the comments below. Several of you guys asked me to make a video on tax write-offs for entrepreneurs, the best tax breaks to take advantage of for entrepreneurs, and the best business structure for entrepreneurs. So that's what I wanted to do in this video. Hope you learned. Appreciate you guys. Smash the like, drop a comment. See you in the next video.